Today's discussion centers around the Amplify Bitcoin 24% Premium Income ETF, a fascinating new entrant in the world of investment vehicles. It promises high income and capital appreciation, but how realistic is that?
The ETF aims for a balance, leveraging Bitcoin's volatility to generate significant income through a covered call strategy. It's a unique approach, and the key is understanding how that volatility is harnessed.
Volatility is usually seen as a risk, not a source of income. How does this ETF turn that on its head?
The strategy lies in writing covered call options. By selling these options, the ETF generates premium income regardless of whether Bitcoin's price goes up, down, or stays flat.
So it's essentially profiting from the act of selling options rather than solely relying on Bitcoin's price appreciation? Right, let's start with the basics. Can you give us an overview of the Amplify Bitcoin 24% Premium Income ETF, BIT?
BITY is designed to provide investors with exposure to Bitcoin's price movements while simultaneously generating income through a covered call writing strategy. The target is a 24% annualized option premium, a significant amount.
A 24% annualized return sounds very attractive. What's the catch?
Like any investment, there are risks. The primary risk is that if Bitcoin's price surges significantly beyond the strike price of the written call options, the ETF will miss out on some of that upside potential. However, the premium income acts as a buffer against potential price declines.
I see. You mentioned covered call options. Can you explain this strategy in more detail for our listeners?
A covered call involves owning the underlying asset, in this case, Bitcoin exposure through Bitcoin ETPs, and simultaneously selling call options on that asset. Selling the call option generates premium income immediately. If the price of Bitcoin stays below the strike price of the option, the ETF keeps the premium and the Bitcoin exposure.
And if the price goes above the strike price?
If Bitcoin's price rises above the strike price, the call option is exercised and the ETF is obligated to sell its Bitcoin exposure at the strike price. This limits the upside potential but still provides the premium income received upfront.
The ETF uses weekly options, not monthly. Why is that significant?
Weekly options allow for more frequent premium collection, potentially leading to compounded income. It also allows for greater flexibility in adjusting the strategy based on market conditions. Bitcoin is known for its volatility, and weekly options allow the fund managers to better capitalize on short-term price movements.
So the higher the volatility, the better the potential for income generation?
Generally, yes. Higher volatility translates to higher option premiums. The ETF is designed to harvest that volatility, turning it into a source of income. Right.
What about risk mitigation? Investing in Bitcoin is inherently risky.
The covered call strategy itself provides a degree of downside protection. The premium received acts as a buffer against potential losses if Bitcoin's price declines. However, it's important to remember that this is not a risk-free investment.
Are there other risks associated with BITY?
Yes, several. Bitcoin's price is highly volatile and subject to regulatory changes. The ETF also invests in Bitcoin ETPs, not Bitcoin directly, which introduces additional layers of risk. There's also the risk that the ETF may not achieve its target 24% annual premium. Yeah.
Can you shed some light on the ETF's holdings and sector allocation?
The ETF's holdings are subject to change, but it primarily invests in Bitcoin ETPs and options on those ETPs. The sector allocation is dynamic, reflecting the underlying holdings of the Bitcoin ETPs.
Is there a specific sector focus?
Not a direct sector focus, as the underlying assets are Bitcoin ETPs. However, the indirect exposure might touch upon various sectors involved in Bitcoin's ecosystem, such as technology and finance.
I see. What about the ETF's performance and distribution policy?
The ETF is relatively new, so its long-term performance data is limited. However, the goal is to generate high monthly distributions, a portion of which may be a return of capital. There's no guarantee of distributions.
So investors should not solely rely on the projected 24% annual premium?
Absolutely. Past performance is not indicative of future results. The 24% is a target, not a guarantee. Investors need to understand the risks involved before investing.
How does BITY compare to Amplify's other Bitcoin covered call ETF, BGY?
Both ETFs use covered call strategies to generate income from Bitcoin exposure, but they differ in their target premiums and approaches. BAGY aims for maximum income, while BA targets a specific 24% annual premium. The differences in their strategies might lead to variations in their performance.
So investors should choose based on their risk tolerance and income goals?
Precisely. BAGY might be suitable for investors prioritizing maximum income potential, while BID might appeal to those seeking a more balanced approach with a defined target.
What are some key considerations for investors interested in BE?
Investors should carefully review the prospectus to understand the risks involved. They should also consider their risk tolerance, investment timeline, and overall portfolio diversification. BITs is not a suitable investment for all investors.
Should BI be a significant portion of an investor's portfolio?
No, it shouldn't be. Because of the inherent risks associated with Bitcoin and the covered call strategy, DIT should be a small part of a well-diversified portfolio.
Let's revisit the use of weekly options. What are the key advantages?
Weekly options offer several advantages. They allow for more frequent premium collection, potentially leading to compounded income. They also provide greater flexibility to adjust the strategy based on market conditions and allow for better capturing of short-term price movements. Finally, they can improve risk management by reducing the risk of missing upside potential or significant adverse movements in the underlying asset.
So it's a more dynamic and responsive strategy compared to using monthly options?
Exactly. The increased frequency allows for better adaptation to the inherent volatility of Bitcoin.
Does including BIT offer diversification benefits within a portfolio?
Yes, to a degree, Bitcoin is a non-traditional asset, and its price movements can be less correlated with traditional assets like stocks and bonds. Therefore, including BIT can potentially reduce overall portfolio volatility. However, it's crucial to remember that BIT itself is not diversified.
So diversification is still important even with BIT in the portfolio?
Absolutely, BIT should be considered one piece of a larger, well-diversified investment strategy.
In summary, BIT offers a unique approach to Bitcoin investing, aiming to balance income generation with capital appreciation. However, it's crucial to understand the risks involved.
The ETF strategy is innovative, but it's not without its challenges. Investors need to carefully weigh the potential rewards against the inherent risks before making an investment decision. Thorough due diligence is essential.
And remember, the 24% annual premium is a target, not a guarantee. So while the potential for high income is enticing, a thorough understanding of the risks associated with Bitcoin and the covered call strategy is paramount.
Precisely. Investors should carefully consider their risk tolerance and investment goals before allocating any capital to BIT.
It was a great discussion. Thank you for insights.